Is it time to buy CSX Corporation today? The railroad industry is currently undervalued. What price should we be looking to enter to maximize our gains and take advantage of this company and the out of favor railroad industry? Today we're going to take a look at CSX, the historical performance of the stock. As always, we will run through the income statements, their revenues year on year, that bottom line net income. We're going to jump into their balance sheet, look at their total debt versus total cash. We're going to take a look at their earnings that they reported last week to see how that fared versus analyst estimates. As always, we're going to run it through the dividend safety, look at some very important financial metrics for CSX Corporation, and then it's going to go into our stock valuation model, getting to our intrinsic value and finding out our acceptable buy price given our margin of safety. So let's jump straight into their earnings, which they reported last week. We can see here their shares did fall after Q2 revenue miss expectations and shipping volumes dropped. So is it a good time now to enter for maximum growth? So we can see here they reported a 3% drop in the second quarter revenue, missing analyst estimates. A few reasons for this. One of them was the fact that there was a drop in intermodal shipping volumes, and the CEO did warn of full year revenues which will be impacted by the intermodal storage and falling coal prices. So we can see last week it did drop 3% after they reported, and we can see here their second quarter revenue declined by 3% to 3.7 billion. Missing analyst estimates. However, their earnings per share did come in line at 49 cents, in line with forecasts. So a mixed bag there. What we want to take a look at now is their historical performance. So year to date, they are up 5%, which is lagging the S&P 500 performance. They are towards the mid to upper end of that 52-week range. They do offer a yield just over 1% at 1.35%. And for those shareholders who have been holding CSX over the last 10 years, you would be up a very strong 295%. So very, very strong historical performance in my opinion. The question we want to find out today is that going to continue, and at what price should we jump in to maximize our gains and that yield on cost? So total revenues, we like to see typically a 3 to 7% increase year on year. December 2018, they reported 12.25 billion worth of revenue. 5 years later, 2022, 14.85 billion. So nice increase over the last 5 years. But when we look year on year, we can see a better picture. From December 2018 to 2020, it did in fact decrease. However, it did then pick up over the last 2 years. So we can see that increase. Now, what we want to find out is, does this reflected in the bottom line, that net income? So December 2018, 3.3 billion reported on their bottom line. December 2022, 4.2 billion. So again, nice increase over the last 5 years. But what we can see is there were some years where it did in fact drop before picking up. What is positive to note, however, even though they did drop, it did then pick up. So it is good to see that you could argue it could be a potential one-off. So we're going to take a look shortly at the last 10 years and that performance in our financial metrics. But before we do, let's take a look at the balance sheet and have a very quick look at their total cash versus total debt. So what we're going to take a look at now is we can see their cash and short-term investments, 1.1 billion in December 2018. And over the last 5 years, looking at their latest quarterly report, it has remained relatively flat, still at around 1 billion. Now taking a look at their total debt, what we can see here is that their total debt has gone from around 14.8 billion in December 2018 to the latest quarterly report at 18.5 billion. So it has increased, and what I will be looking now is to see how that affects the financial metrics of the organization and that dividend safety. So a score of 85 for CSX Corporation, making it very safe, which is good to see for shareholders and potential investors. Market cap 65 billion, making it a large cap company. Now, for those that believe we are heading into a recession, a few key metrics here. Firstly, they have been paying dividends for 20 years without a reduction. They maintained the recession over the last recession in 07 to 09. So they didn't cut it, but they also didn't increase it. Recession sales, negative 20%, which was in fact below the average growth during the last recession, which was also negative. And the recession return at negative 51%. Fairly close to the S&P 500's negative 55% return. Now, they have been paying dividends increasing year on year for the last 18 years, and their last increase this year at 10%, very nice to see double digits. Last 5 years compounded annually at 9%, very positive. And over the last 20 years, excellent to see 16% year on year. And as I always say, make sure you are getting at least 4% every year in your dividends or even your salary increases or other income producing assets, because the US inflation over the last 40 years was 4%. Now, dividend yield theory states that a company is undervalued when the current yield is sitting above the 5-year average. And what we can see here is it is fairly in line with that 5-year average, so you could argue reasonable valuation. As always, we don't look at any model in isolation, and we'll draw our conclusions towards the end of the video. Forward PE effectively in line, very similar to the 5-year average of 17.8, currently sitting at 16.6, and it is slightly below the sector PE at 18.8. Now, the 52-week price range is sitting at that mid to upper end. We can see here $32 with that 52-week high at 34. But as I always say, if it is at the 52-week high, it doesn't mean overvaluation. And if it is at the 52-week low, it doesn't mean it is undervalued. Now, the earnings payout versus the free cash flow payout. If you've been seeing my videos regularly, you know we look at the free cash flow purely due to the fact that the earnings is susceptible to manipulation through management by accounting. And you can always see they never are exactly the same. Now, I always like to look at around 60% or less, as that means there's room to grow that dividend double digits, which I prefer. And if you want to see my other 7 golden dividend metrics, do check my pinned YouTube video. Now, essentially from 2018 onwards, so the last 5 years, even their 6th year expected, it is around that 30%, just below 30%. So very, very positive to see. 2022 and 2021 at 25%, with 2023 expected at 26%. So very, very positive to see. Likewise, I do prefer to look at the free cash flow per share. 2013, 31 cents. 2022, $1.63, with 2023 expected to be $1.71. So there is that nice growth over the period. And this is why I like to look at least 10 years of data, because if you can see here, if you were just to look at 5 years, 2013 to 2017, you would have a slightly different view. So if you do have the data in any analysis you do try and look for at least 10 years. Now, sales growth, as I mentioned, 3 to 7% year-on-year increase. It could possibly be due to the cyclicality of the business, but what we can see is there has been 4 years out of the last 10 years with negative growth. So not the greatest. We can see 21 and 22 with double-digit growth, which is positive. And when we look numerically speaking, 2013, 12 billion of sales, 2022, 15 billion. It isn't the greatest growth of a company, but you are still having that consistent growth over the last 10 years. So there are positives as well as some potential negatives. Shares outstanding. Now, if you've seen the other railroad companies that I reviewed, UMP, CNI, you see that they do follow a very similar pattern where they are one of the best companies at doing share buybacks, returning excess cash to our shareholders. 3.06 billion of shares outstanding in 2013. 2022, 2.14 billion. So nearly 1/3 of shares bought back over the last 10 years. Very positive to see, and it's something I really like to see as an investor, combined with that nice dividend increase in growth year on year. Likewise, ROIC, another one of my 7 golden dividend metrics, at least 10% plus. Therefore, management are effectively allocating that capital. Very consistent as well, between 12 to 15% really across the board. So very nice to see, very positive. Again, very consistent, very nice to see. Operating margins above the 12%, free cash flow margins above the 5%, especially from 2017 onwards. So a very good, strong business, in my opinion, based on the data we've seen so far. Now, net debt to earnings before interest, tax, depreciation, and amortization, we do like to see below 3. And what we can see, it has consistently been below 3 and is expected to be 2.31 in 2023. Essentially saying that in 2.31 years, the company could pay off all of its debt net of cash if needed. And here we're just showing that 57% of the company's debt was from, their financing was from debt as opposed to equity. So far, I think quite a lot of positives, a few things just to look out for, but so far, I personally quite like the business. Now, if you are enjoying the content, value is being provided, do hit that like button, do subscribe for continued content on the channel. And if you want to run your own companies through the model we're about to go through, do check the pinned comment and description. Now, Graham's model, we're running it through the earnings per share at 204, growth rate as expected by analyst estimates at 8, with the current yield on AAA corporate bonds at 4.69, giving an intrinsic value of $28.71, slightly lower than the current trading price and just above that 52-week low. Now, multiples model, companies in a similar industry, similar size, we have So NSC, CNI, which I've also reviewed, CP, which I've also reviewed, and Union Pacific, again, which I've reviewed. Do check those videos out if you are interested in them. We then put in their stock price, EPS, get the P multiples, of which we do the average, multiplied by the earnings per share, to get a stock price of $42.46, showing some real nice upside to that current share price. We then move on to the dividend discount model, where we can see the average growth rate at just below 10% year on year. I've gone between 6 to 7%. I've gone for around 6.75%. I think you could argue a higher rate, but again, I think I want to be a bit more on the conservative side with my estimates and judgments. Gives us a DDM price of $37.58. Nice upside to that current share price. Now, the discounted cash flows, we have the free cash flows year on year, the average growth rate, and we've gone for a growth rate of 7% in line with analyst estimates. In conjunction with our discount rate at 8%, we get the present value of these future free cash flows terminal value, add the cash, subtract the total debt, get to our equity value, and the shares divide by the shares outstanding, again to show some nice upside at around $39. Now, as always, if you are enjoying the content, do hit that like button, do subscribe for more content directly on your doorstep. And now the intrinsic value is essentially the average of the four models we've just gone through at $37. Now, Wall Street are forecasting the price over the next 12 months to hit around exactly the same as our intrinsic value at $37. Now, in terms of the price and what we're looking for, typically with a company with a wide moat, strong financial metrics, we would be looking for around a 10% margin of safety. However, you could justify a slightly higher one, but that does come down to the individual investor. So around 10% margin of safety, your acceptable buy price would be around $33. Now, if you wanted essentially a higher margin of safety, around 50%, your buy price would be around $31.48. And if you wanted a 20% margin of safety, your acceptable buy price would be around $29, which, as we can see here, is still around just above that 52-week low. Now, personally, I don't hold the CSX. I would be looking to add this to my portfolio at around $30. There is some nice upsides at around $30. It would give at least around a 20% upside, which is what I would like to see. So for me personally, it is on my watch list at $30 to $31. However, do let me know your thoughts in the comments. Are you looking to buy? Are you a shareholder looking to sell or add more? Or are you purely on the sidelines? And let me know if you do own any other railroad industry companies that you prefer, or if this does catch your eye. As always, do subscribe for more content. Do let me know your thoughts in the comments. Have a lovely, lovely day and catch you on the next episode. Take care.